Ever felt a little lost when people talk about stocks, shares, and equity? It sounds complicated, but I promise it's super simple. By the end of this video, you'll get it, and you'll feel way more confident about your financial knowledge. Let's break it down. First up, what is a stock? Think of stock as the big picture idea of ownership in a company. When you hear someone say, "I invest in tech stocks," they mean they invest in ownership of technology companies in general. The term stock market refers to the entire marketplace where ownership of all these different companies is bought and sold. So, stock is the concept of a company as a whole, available for public ownership. Now, what are shares? If stock is the company itself, shares are the individual units of that company. Imagine a company decides to divide its ownership into 1 million pieces. Each one of those pieces is a share. So, when you buy stock, what you are actually buying are shares of that stock. If you buy 100 shares of a company, you own 100 specific units of its ownership. To put it simply, stock is the whole pie, and shares are the slices of that pie. So where does equity fit in? Equity is the value of your ownership. Let's say you own 100 shares, and each share is currently worth $10. Your equity in that company is $1,000. It's the monetary worth of your stake. For the company itself, equity is calculated differently. It's their total assets minus their total liabilities. This is often called shareholder equity on a balance sheet. As the company becomes more valuable, its total equity grows, and the value of your shares, and thus your personal equity, also increases. Here's the easiest way to remember it with a cake analogy. Imagine a company is a giant cake. The stock is the entire cake itself. The shares are the individual slices you can buy. And your equity is the value of the slices you own. If you have 2 slices of a very fancy, expensive cake, your equity is higher than someone who has 2 slices of a cheaper cake. Let's do a quick recap of the key differences. Stock is the general term for ownership in a company. Shares are the specific, countable units of that ownership. And equity is the financial value of the shares you hold. They all work together seamlessly. You decide to buy the stock of a company you believe in. To do this, you purchase a specific number of its shares. The total value of those shares represents your equity in that company. The more shares you buy, the larger your slice of the pie, and the greater your equity. So why does understanding this even matter for a beginner investor? First, it helps you understand exactly what you're buying. You're not just throwing money at a company name. You're purchasing tangible units of ownership. Second, it makes financial news and reports much easier to digest. When you hear that a company is issuing new shares, you'll know it's increasing the number of ownership slices available. Finally, this basic knowledge builds a strong foundation of confidence. Investing can feel intimidating, but mastering the language is the first step to feeling in control. And here is a final beginner tip. Don't get too hung up on the terminology in casual conversation. In everyday chats about investing, you'll hear people use stocks and shares interchangeably, and that's perfectly fine. For example, someone might say, "I bought 10 stocks in Apple," when they technically mean 10 shares. Everyone knows what they mean. The most important thing isn't perfecting the vocabulary, but focusing on the quality of the companies you invest in, understanding the risks, and thinking about your long-term goals. I hope this clears things up. Investing is a journey of learning, and you've just taken a big step forward. If you found this helpful, a like and subscribe would be amazing. Thanks for watching, and I'll see you in the next video.